What's up, everybody? It's Megan here with the Financially Free Era podcast. And today we're going to be chatting about just some bite-sized little newsworthy nuggets, I call them in my newsletter that I send out on Fridays for our SLP Wealth clients. Things that are just in the financial planning space or the finance space, really, that I thought were kind of interesting, kind of something to chat about that's kind of related to personal finance or affects maybe personal finances. And since it's Thanksgiving week, hey, you might be on the way back from Thanksgiving. Hope it went well, by the way. Hope it was smooth. Hope it was fun. You got to eat a lot of good food. Hopefully, no, family awkward conversations, although I know those are inevitable. But yeah, so these are I've got I think how many do I have? I've got nine different newsworthy nuggets that I had in my newsletter over the past couple months that could be just fun to chat about on your way home, from Thanksgiving. So this will be short, light, short and sweet. And I'm looking forward to just diving into something that's, we could talk about a lot of different things today, and actually this is similar to my own eating personality where I am a girl dinner kind of person where I love lots of like different things. That's why I liked Cracker Barrel for so long because you got so many sides. Most restaurants you go to, you'll get like one side or maybe two sides, but Cracker Barrel, you could get three or four. You could get a whole side plate where it's four sides. Love it. So I like bits and pieces of different things, and this is kind of what this episode is going to feel like today. So, hope this is as fun for you as it is for me. Let's jump in. All right. One of the newsworthy nuggets I threw in my newsletter was about, will self-driving cars save us on insurance? Auto insurance is what I mean. So, self-driving cars, they're out there. Have you seen Waymoos? I know they're in certain cities. I saw a lot of them when I was in Austin, Texas. They are in Atlanta. And I know they're in different cities right now, but those self-driving cars, self-driving Ubers, where you could literally get in and no one is driving the car. Wild, right? We are in the future. Americans spend about 2,600 a year on car insurance. And the question is, could fully autonomous vehicles help cut that cost? Because it takes out some of the human error when it comes to driving. I think the answer is maybe, but don't hold your breath quite yet, right? There is safety in tech. So think about automatic braking that didn't used to be the case. Like that was not a thing 20, 30 years ago, automatic braking. Or lane departure warnings. I feel like that's still not even in my car, honestly. Mine's a 2021, so I don't even have that safety feature in my car where like if you're driving and the car picks up that you are moving into a different lane, you don't have your turn signal on, it makes a little warning sound, right? That's something that can help. But those things have shown some of these tech safety tech improvements have shown that they're starting to lower accident rates. So that's really positive. And then the Waymo robo taxis that I just talked about, they're actually crashing less than most of us humans. I will say I did see where Waymos have to be, of course, super careful. They've got cameras. They know when things are in front of them, when things are behind them or to the side of them. So if something's in front of them, they're just going to stop. And what I saw a lot of in Austin was folks just took advantage of that. Austin is a pretty walkable city. So there'd be like four-way stops or like the light would turn green, but a Waymo was right there. People would still keep walking and walk across the street even though they don't have the right of way because they know the Waymo is going to stop and not going to honk at them like a human. So, and I think it's kind of become this joke like around college campuses or for younger folks like who are out and about to kind of mess with Waymos where they will intentionally jump in front or stay in front of these cars because they will not move forward if there is an obstruction in front of them. So there's some of that immaturity that's happening. But with me, Waymos, going back to the point, they're crashing less than the rest of us. But there is a catch, right? So fully self-driving cars, they're expected to only really take up 4% of the new vehicles by 2035. So that's 10 years from now. 4% is a really small number of vehicles. So unless your car is, turning into the Jetsons ride overnight, don't expect massive insurance savings anytime soon because that's still kind of working its way through our economy, through our system, through the insurance system. But for now, I think the good news is premiums are finally starting to level off. Auto insurance premiums, it seems like, after years and years of steep hikes. And maybe that's the positive here, but maybe some other not so fun news, just kind of giving you all angles, is regulators are demanding lots more data from these insurers to make meaningful rate changes. So if we're talking about maybe rates dropping in the future because of these self-driving cars, there's going to be a lot of data that has to back that up, which is just going to take time. So patience is the name of the game here when it comes to self-driving cars. Can it save us on insurance? Sounds like it could in the future, but it's not something that we can really participate in or benefit from now. All right, next newsworthy nugget was that mortgage rates have taken a dip. And this was we're in November right now, so I think this was about a month ago, but we just saw the biggest one-day drop in over a year. We saw rates slide to 6.29% after maybe weaker than expected job reports came out. But that was down from 7.08%. That's kind of the peak we saw back in May. And lenders are quoting rates in the fives even. So it depends on the lender, depends on where you are, your credit, of course. But we were seeing some interest rates in the fives, which was a lot lower than where we've been seeing them lately. So for homeowners, what does that mean? This can translate into a savings. So doing some math, about $169 a month saved on maybe a $450,000 mortgage. So that's some savings, right? $169 a month. That's 2, 3 dinners out, or maybe something cool at Target. Or it could also be a contribution to your brokerage account for your student loan tax bomb, something like that. So in a nutshell, yes, rates went down. We're seeing rates lower than they have been, than the peak maybe was over the summer. But folks are kind of waiting still when it comes to purchasing. There's a lot of homes still like on the market or staying on the market a little longer than usual still, even with this lower rate news, right? And I think it's because folks are waiting for this to be kind of solid. They're waiting for these rates to be solid, to feel solid before making a move. So I think in a nutshell here, like kind of boiling it all down, where mortgage rates are going, what's happening right now, I think it's a hopeful sign for affordability. But there's not like fireworks. There's not a big change or a big moment for the housing market just yet. But there have been some interesting conversations about longer periods for mortgages. 30 years, the longest mortgage term that you'll find today, but Trump has been talking about maybe even longer than that. I don't know how much I love that. That's a podcast for another day, maybe, or a topic for another day. But that's where we're at with that newsworthy nugget. All right. So back in September, let's talk about jobs. The job stall, the Fed really kind of locking in on things. The August jobs report came back and it was pretty weak compared to what was expected. Only about 22,000 jobs were added. That pushed unemployment rates up to about 4.3%. And prior months weren't prettier than that, right? June saw a job loss in the market, and this was one of the first declines since maybe 2020. So the job market is not looking amazing. Wages are still modestly ticking up, kind of keeping up with inflation, I think. But the question is, with a cooling labor market, what does that mean? What does that mean for our economy, for inflation, for you, right? Or is it really just a cooling labor market, or is it something bigger? And we're now in November. I don't know if I could quite say like it was something bigger at this point yet, but time will still tell. So we'll see where things are going with the unemployment rate and with job reports here coming up. All right, another big newsworthy nugget that this isn't new news or anything, but student loan forgiveness is back on. This is a weird, frustrating thing that was going on in the student loan system. The Department of Education basically was saying, hey, we're putting a pause on all loan forgiveness because we got to get our stuff together. Okay, fine. But that really put people in a tricky spot because there were people who were legitimately eligible for loan forgiveness and they were just being pressed paused on, right? They couldn't move forward with their plan. They didn't quite know what they needed to do. So finally, the Department of Ed came back and they said, "Hey, okay, I understand. You know, basically the American Federation of Teachers got things really heated and lit some fires, and that did help get things moving along again. So the breakdown right now is forgiveness has resumed for people who are on the IBR plan, ICR, and pay. Save is a dead plan. So that save plan, if you're still hanging out on it, there is not going to be forgiveness associated with save at all. You are not accumulating forgiveness credit if you're hanging out on save and the save forbearance currently. There's not a lot of benefit to staying on save. There are certain circumstances where I'm saying, yeah, sure, that's fine in somebody's planning case, but generally speaking, we want to get back on track with if we want to get back on track with loan forgiveness, we need to be switching to IBR, ICR, or pay. And there's that new plan that's supposed to come out sometime next year called WRAP. We can't apply for it now, but that will be something that we can look into. But anyways, forgiveness is resuming, and that just means that if you've already hit your 240 months or 300 months towards the longer term forgiveness, they're processing those forgivenesses now, and that's positive. Same with PSLF. PSLF was never quite frozen, I wouldn't say, maybe except for folks on save, but PSLF forgiveness has been moving along as well. So also the good news with this was let's say you were someone or you knew someone who was going to hit 240 months of forgiveness this year or 300 months of forgiveness this year, but we were kind of in that limbo. Like we hit the timeline, we were told we hit the timeline, or using that little Reddit trick that we've shared in our newsletter to figure out where your payment count stands. If we know we're over those thresholds, and we know we're supposed to be rightfully eligible for loan forgiveness now in 2025, what people were worried about was processing times, because processing times were taking forever to actually get the loan forgiveness like done and executed. And what do we know about 2025? Well, 2025 is the last year where student loan forgiveness is tax free based on what they put into effect back in 2020. And so if they got loan discharged in 2026, the worry was, oh my gosh, am I going to have to pay taxes on that at that point? Not for PSLF. PSLF has always been tax free, but for the longer term forgiveness, that was a concern. It was like, hey, I rightfully got to my 25-year or my 20-year timeline to forgiveness, and I should be getting forgiveness now, but they're taking forever to process my application. What do I do? Am I going to have to pay taxes if this gets forgiven ultimately in 2026? And they came back and clarified, thank goodness. They said, hey, if you are rightfully getting loan forgiveness because you hit your payment count in 2025, even if the forgiveness gets processed next year, you will get honored with that no tax implication. So that was really positive because that was a big concern for folks who were waiting and waiting and waiting for the Department of Ed literally to do their job, discharge loans that needed to be discharged, and they didn't want to have a consequence, a tax consequence, when they rightfully shouldn't have. And the good news is that they're not. So that's really positive. A couple other things. Let's see. So again, no surprise tax bills. Borrowers are not going to owe taxes on forgiven balances, even if the discharge doesn't process until next year. So if it's still taking a while, and it ends up getting forgiven next year, don't sweat it. If it was rightfully supposed to be forgiven this year, you're not going to have to pay that tax bomb. Another good thing that they pointed out was refunds are going to be coming to anyone who kept paying technically after they qualified for the loan forgiveness. Now, this has always been the case. It's supposed to be, right? So if you made 305 payments, but forgiveness is supposed to happen at 300 months, you would get refunded the 5 extra payments that you made. That is still going to be the case. So that's positive, but it was just nice to hear them say that, right? And the court was going to continue to monitor the Department of Ed to ensure that they follow through with these things that were talked about, the forgiveness starting to get processed again, refunds happening, and then folks not getting charged the tax bill when they got loan forgiveness this year. So that was a win. Things are still a little tricky. We'll keep you informed as things continue to evolve. Now, the next newsworthy nugget I had on here, I should have probably talked about when I talked about mortgage rates here a second ago, but mortgage rates, why are they not going to go back down to 3%? So if you guys remember 2020, 2021, a little bit of 2022, mortgage rates literally went down under 3%. Are they going to go back there? No. I think the short answer is no. So a quick reality check is the national debt just crossed $38 trillion, trillion with a T, and it's not just a government problem. This affects mortgages as well. So economists have said that we've officially left the 3% mortgage era behind us. Maybe even 4%. And we haven't seen 4% since then. We've gotten as low as like 5 something, like we talked about a minute ago. But as Uncle Sam is borrowing more, investors demand higher yields. So that pushes long-term rates and mortgage costs up. And Larry Summers, he even warned that the bond market could even hit a wall, sending rates up a full percentage point, maybe overnight. So that's something to be aware of too. But if you're buying a home, probably now you should be expecting, I would say guard your heart and expect 6 to 7%. And that's just kind of the new normal. That's what it will be. And kind of my advice here is just focus on what you can control. You can control your credit score, you can control timing, the price of what you're purchasing, or like, exactly what you're committing to purchasing, and shopping around. So I wouldn't get too hung up on being super upset about the rate. Yes, would it have been nice to get in at the 3% rate or the 2 point something percent rate? Of course, yeah, it would have been. But that's not where we are today. We've got to move forward, and 6 to 7% is probably where we want to mathematically be calculating things off of and mentally be preparing for when it comes to home ownership. All right, another newsworthy nugget that I put in our newsletter that I thought was kind of interesting was inflation. Inflation is throwing a party, and we are paying the tab. We're picking up the tab, which doesn't feel very fun. So inflation is gate crashing our wallets. And I would say, from what it looks like and from different reports, it's up about 3% over the past year. So that's nothing crazy. That's kind of what inflation has looked like year over year. But gas, energy, and food are some of the main culprits of what costs are looking like and what costs are increasing. So looking at specific things, your morning coffee, let's talk about that. Basically a luxury now, which if we're looking at different reports, different numbers, this is up maybe nearly 19% from last year. So the coffee that you drink every morning, the cost is up probably about 19%. And you probably could look at past receipts if you have like an app for your grocery store where you could see past orders or past receipts. You could probably see the difference between what you spent a year ago and what you're spending now on the same bag of coffee. And same for ground beef. That's another example. It's up about 13%. I've definitely noticed that from last year and years before. Ground beef has definitely gone up. Candy and chocolate. Any sweet tooths out there? I am. I definitely am when it comes to chocolate and things that are sour. Um, so chocolate has gone up and the cost. Eggs, which actually eggs are kind of interesting. I was looking at the different like just random different foods if they were going up or down or kind of where their costs stood compared to last year. Eggs are actually giving us a break, but I will say eggs went up in years past. Eggs used to be a lot cheaper, maybe 2, 3, 4 years ago, and they did have a hike, but they chilled out a little bit this year. So they gave us a break this year when we were doing some comparisons. So why is this? Why are these different things happening? Why are some things more expensive than others? Well, tariffs that could be blamed for some. A weaker dollar is kind of creeping into prices on clothes, on furniture, on canned goods. Housing costs are maybe slowly climbing as well. Gas is up, and I think your budget is working very hard, and you are a hard worker. You are experiencing these changes in your budget. So, one tip is just to monitor where spending is going, where our cash flow is right now, because variable expenses are going to be variable. But when it comes to inflation and the cost of goods and things just from where they were last year, you may be spending a little bit more than what you were used to spending. So tracking spending is helpful to just notice some of these trends and see if there's ways that you can either reduce or cut spending in certain areas to kind of make room for those budget adjustments that are going to happen with inflation. All right, number seven, government. The government was considering selling your loans, your student loans, and we're still kind of watching out for what the heck is going to happen with this. The Trump administration floated the idea of selling parts of the federal student loan portfolio, about 1.6 trillion, to private investors. And what this means, what this means is Wall Street could potentially own pieces of your federal debt. But there are a lot of problems with this. And you have probably gone through a couple different servicer changes. If you've got federal student loans, your loans, and you might have said the term like my loans have been sold, multiple times. It's not that they're being sold right now, or what's happened in the past. It's that these servicers that manage your loans, that collect your payments, they are contractors for the government. And their contracts can expire. They could get fired. They could get replaced. And so what happens when that happens? Well, you're going to move to a different loan servicer that the Department of Ed approves. And so you probably have moved around, but this would be different. This is literally the Trump administration saying, let's sell this debt to private parties. But the problem with that is private lenders do not have the same borrower protections or flexible repayment options as the federal system. So structurally, it would change what student loans are. So that is a huge problem in and of itself that would have to be figured out because everybody's got promissory notes that promise certain things. So this would not be a fast thing or something that happens overnight. No way. Um, In reality, too, it would also just be super tricky to find buyers who were willing to pay what these loans are worth, given how convoluted the servicing of them has become, because they are, as we know, federal student loans are complicated. So a private lender is not going to want to, if they're going to have to abide by these same like terms and conditions of the promissory note, they're not going to want to do that. They're just not. And they don't have the same collections powers as the government because the government can garnish your wages. They can garnish your tax return if you're not paying your student loans. Private companies can't do that. So the government is working on smaller margins for, the interest that they're charging, how much they're collecting from borrowers as people pay their loans back. Those margins would be even smaller if these moved over to the private sector because there's no protection. There's no guarantee that they're going to get paid on these loans, right? And it's unsecured debt. They can't go and evict your brain or what is the term called for your car? If you get your car impounded, they can't go impound your brain, right? So it's unsecured debt. So private lenders are just, I don't think they're going to be attracted to this as an offer. It's not an attractive offer. So I think this will backfire. I don't think this is really going to go anywhere, but it was something that was brought up. And I think it's brought up because the Trump administration is trying to find ways to reduce the outstanding debt that the government holds. And that was one of the ways. 1.6 trillion. I mean, that's a decent chunk of debt. So they were trying to figure out ways to push it off somewhere else. But I don't think this is going to be one of those things. All right, number eight, insurance gaps are costing Americans a lot of money. So yeah, we'll talk about insurance again. Americans are paying for insurance. They're paying more for insurance than ever. And what's kind of frustrating is many people aren't actually being as protected as maybe they once were. So premiums are going up, but protections are going down almost. About 42% of home insurance claims close without a payout. That was based on some 2024 data. And 41% of medical providers reported that at least 10% of claims were denied. So that's not good. But premiums and deductibles keep increasing. Why? Well, what's and actually, this was an episode we did on the Student Loan Planner podcast a while ago now, but we talked to some property and casualty insurance experts, and they were talking about how there are just things happening right now let's talk about property and casualty specifically. So, fires in California, flooding in East Coast, in the Carolinas more recently, hurricane season, like these things, these natural disasters are getting to a point where they're destructive, right? In and of itself, but they're getting more frequent and they're getting more destructive, even more destructive. And so these insurance companies are on the hook for protecting property for certain catastrophic events like this. So that's driving the cost up. It's driving insurance carriers to pull themselves out of markets, pull themselves out of states, even. There are certain carriers that will not provide insurance coverage in the state of Florida because of hurricane season, or the state of California because of the fires. And that's becoming more common. And so insurance companies are trying to kind of cut off their exposure to certain risks by completely pulling themselves out of the market. So what does that do? Well, the people who stay in the market, they're going to have to charge something that helps them stay a profitable company, to be able to pay out those claims when the time comes, even though the risk is kind of high that they may have to pay out at some point. And so that's affecting insurance premiums. And I think another thing that expert told me was just that the structure of policies is being looked at closer and more harder, I guess you could say, where, there were a lot of, yes, XYZ will be 100% covered, and there weren't little stipulations attached to that. So, for example, this was just something that was super common in Georgia. I don't know if it is everywhere else, but roofers, roofers would go door knocking around neighborhoods after just kind of a regular thunderstorm, and they would send a drone up. They'd offer, hey, we'll take a look at your roof, see if there's any damage. If there is, we'll file claims under your insurance company. And that's how they would get paid. And what these companies were doing was they were kind of taking advantage of a loophole, I'll call it a loophole, where there weren't protections in place exactly for a lot of carriers on how much they would cover if there was damage to a roof. And so, they would go into neighborhoods where these houses have 10, 15-year-old roofs. Of course, there's going to be some wear and tear, and they'd take a look at the roof, find a couple things that need to be maybe addressed or should be addressed soon. And they were able to, based on the contract language of somebody's homeowner's insurance, able to get a full roof replacement, completely paid for by the insurance company. So, yeah, great for the person who was able to take advantage of that. Not so great for the insurance company, for basically having to pay full cost for a depreciated asset that was 10, 15 years old. So, there's a lot of like things that go into that. I'm not an insurance expert. I just thought that conversation was really fascinating. So if that's something that's kind of interesting to you, just definitely go check out the Student Loan Planner podcast. Search, I think you could just search insurance, and that'll probably pop up as one of the episodes. But it was kind of an eye-opening episode because I learned a lot about just what kind of goes into the cost of coverage and why the costs are going up so much as of lately. And it's something that we can't really control. So the real takeaway here, the real financial protection isn't just about buying the insurance. It is understanding what's not covered, what is covered, reviewing your policies regularly, considering replacement cost coverage. That was a really important piece to that episode. and saving enough, having emergency savings to cover your high deductibles, like if you do have higher deductibles on your insurance coverages, plus a little bit for emergencies. So I think those are some of the takeaways where, yeah, insurance costs might be going up. It might be a necessary evil, but it's also super important to make sure you understand what you have and if what you have is adequate or if it's overkill. It might also be overkill, and you might make that decision to make some changes. So that's some thoughts there. And then the last kind of newsworthy nugget for the past couple months was about the government shutdown, that drama. Thousands of federal workers across agencies like the Treasury, HHS, Education, IRS received some mass layoffs, unfortunately, and it was breaking the usual non-essential employees just get furloughed rule. So unions were suing, and there's still some that are kind of actively in that process, calling it illegal and a blatant political move for what was happening around that time. So hundreds of thousands of other federal workers remained furloughed, working without pay as the government was really trying to kind of limp along. So we've had, a really not so awesome back half of the year, 2025, I would say. This wasn't a typical shutdown. I think politics were really shaping how people were experiencing it, how things played out, and it had some ripple effects into programs and services across the board. So it's been an interesting back half of the year. That's what I'll say there. But all that to say, those were just little quick tidbits of things that I threw into the newsletter that I pulled from, just things that might affect you financially speaking, might be conversation starters or hopefully not argument starters in your car ride home from Thanksgiving this weekend. But that is a wrap for this week's conversation. As always, my goal is to help you, understand what's going to affect your finances and how you can better protect your finances. How can you improve your money and your behavioral habits and work towards those goals a lot faster, right? That you have, and how things will impact your financial life. And I think some of these stories can contribute to the conversation there. And if you're thinking about how you can adjust your financial plan in response to maybe some of these things, or this has kind of jogged some thoughts on what you should be doing with your plan, definitely don't hesitate to reach out to your planner. Your planner is accessible to you throughout the year. If you're a financial planning client with us, and if you're not, check us out. We do comprehensive financial planning, help you get on track with everything that your money touches. But thanks for tuning in to Financially Free Era, and we'll catch you on the next week's episode. But I hope you have a lovely rest of your Thanksgiving break, your start of the holiday break, holiday weekend, and I'll catch you on the next one.